Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes, the first full week of quarter two, 2022. We look back to the first quarter of 2022. Certainly, the central bank expectations, the repricing in the market front and center, couple that with obviously a war that hit us at the same time. We look at those expectations. A lot of the talk in the marketplace right now is clearly around the yield curve. We were predicting yield curve inversion very early on, certainly in curve flattening trades from 2021, much of which has really played out here. And now the question is, and all around the short end, it's really been around the short end. If you look at two-year yields, and we've talked a lot about this, we paused in and around 150. If we go back to 2018, certainly the move now that we've seen closer to 250 with 3% in sight, 3% was the peak in 2018, and of course, long end rates in tow, but with a strong yield curve flattening bias, which really curves are doing what they're supposed to be doing here. They should be flattening as central banks tighten. The Fed has pointed to the very short end of the curve, how steep that is, to counter some of the flatness that we've seen in spot curves. But the reality is that curve is very steep because we priced in a very aggressive Fed, and the Fed really, they haven't done anything much yet. So the expectation now is, in our words from our weekly, the real liftoff is coming. If you listen to New York Fed President Williams over the weekend, San Francisco Fed President Daly, now in conjunction with the broader Fed chorus, talking more aggressively about the potential need for 50. We've advocated the Fed actually go 50 at the May meeting and the June meeting in conjunction with balance sheet runoff. But there's certainly an element of catch-up here. But with regard to the bigger picture, you look at the neutral or perceived neutral rate, which in New York Fed President Williams' words, neutral or normal, whatever that means, I don't think we really know what neutral means. And we found that out in 2018 where the Fed actually raised rates and then they had to bring rates down again. We've referenced 1994, and St. Louis Fed President Bullard has referenced that period where, and the two-year chart looks very much akin to that with a very steep slope upward where the Fed actually took rates much higher and then had to bring rates down to recalibrate the level of the funds rates to the economy. And we think this could certainly be a period like that moving forward. And then in conjunction with that and the clear focus, I think this week, two things. We do get Fed Governor Vice Chair Brainard, who will speak midweek in terms of her outlook on and thoughts on inflation. I think the market's going to be watching that. And then certainly the FOMC minutes, which will be released on Wednesday. Chair Powell clearly saying, watch out for the minutes. The Fed has been very transparent with regard to what that potential balance sheet runoff program is going to look like, saying it will look very familiar. So reverting back to a period of time where we came out of the global financial crisis. But we know it's coming much quicker, and we know with the composition of the balance sheet, it's likely to be much faster. So those will be the two highlights this week. We're very light in terms of Treasury supply. And with regard to economic data, again, it's a lighter week coming out of last week where we had both the PCE printing 3.5 times the Fed's target, and in conjunction with that, a very, very strong employment number, putting more pressure on the Fed here to move more aggressively in a shorter period of time and more pressure on the yield curve. With regard to broader yield curve views, our thoughts are pretty consistent. If you look at the yield curve over time, yes, recessions do lend itself to being in and around these yield curves. But even a curve like the 2s-5s curve, which now is getting very, very flat, caught our attention. If you look at that curve before the housing crisis, we stayed flat to inverted for a number of years. So yes, at some point, the recessionary forces are going to hit this economy, but by no stretch of the imagination does an inverted to flat yield curve right now mean that a recession is imminent. Wishing everyone a great week ahead. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities.